Well, we should be lightening up a bit for this reading as we close it out. We've gone through liability-based approaches. You've seen there's a spectrum from lower risk to higher risk. Hopefully you're adding more value as we move down that spectrum. Tracking error refers to what is the volatility of the value added created. So we move into higher risk, it's less certain what will happen, but we expect we'll be able to add more. We also saw in liability-based, there's a lot of time value of money concepts because you're comparing asset and liability characteristics. It's heavy on the time value of money. Now we're moving over onto the total return-based approaches. We're going to talk about the three primary categories: pure indexing, enhanced, unrestricted active management. But once again, it's a spectrum. We're moving, we're shifting through. There can be gradations between it too, but we should be adding additional value, but the certainty of the value added will not be as high as we move to more active management strategies. Now, in subsequent readings, we're going to come back and we're going to talk about techniques and approaches to do things. You can relax a little bit. Here we're just going to talk about what do we mean by these three terms and how do we distinguish these three terms from each other. So let's think of this spectrum. We're going from completely passive. We're just going to match the characteristics of our index to we can deviate in any way we wish, fully active, but we're supposed to outperform that index. Now, you may well have the impression that pure indexing means exactly match everything in the index. And what is the Institute telling you? That's probably not practical. In the bond world, that would almost never happen. So pure indexing, we've actually got to loosen that up a little bit. Due to the lack of liquidity, the sheer number of bond issues exist. If we're talking about a broadly based bond index, pure indexing is probably completely impossible to implement. Or if you tried to do it, it would be exorbitantly expensive. Some of those bonds just don't trade. So even in pure indexing in the bond world, as long as we're matching all the characteristics, it might still be considered pure indexing. We use some expediency. You've got to start to become practical. They will describe the questions in such a way that they're answerable if you understand this need to be practical. Now, let's say, for example, we wanted to construct an index in the United States of only U.S. Treasury bonds. Well, maybe you could do a pure index of that. I mean, that might be possible. That's not that many different bonds, and they're the most liquid things we can find generally. Maybe it's possible. But even then, if one of them's really hard to buy and the price is being bid up, why don't you switch to another one? It's not really introducing any significant risk by doing it. So we really do want to match the risks, but we may need to compromise a little bit in the bond selection, even with pure indexing. Enhanced indexing, yes, we will allow the characteristics of the portfolio to start to differ a little bit. We're probably going to match the duration of our index because mismatching duration is just too much risk, too much exposure to changes in interest rates. But we could allow some modest deviations. And if we move all the way to pure active, we don't put any restrictions. Do whatever you think makes sense. But the goal is you should be adding a lot of value compared to the return of that index. So some important things to know. If we do want to control primary risk factors, what are the things at minimum we would be talking about? Duration. We would match the modified duration. If our modified duration matches that of the index for small parallel shifts in the yield curve, they will behave the same. And our goal, if we're an indexer, is to match. If we don't want to take interest rate bets, let's match modified duration. Now, these formulas, and I think I pointed this out in an earlier segment, they're written as modified duration. Always remember, modified duration does not consider the effect of embedded options. If we've got embedded options, don't use modified duration. The Institute expects you to realize now, of course I'm going to shift to effective duration if I've got those option features. As a practical matter, if you see modified and effective and they're not the same number, we got option issues. We're going to use effective duration, and you are going to. That's not enough. That's only parallel shifts, and we've already started to see how when interest rates change at different points on the curve, only matching aggregate modified duration may not be enough. You should also match key rate duration. A key rate duration is a hypothetical number. If one single point on the yield curve shifted, what would be the change in value of my item? So suppose we had a key rate duration for the 1 year point. If the 1 year point changes, that yield shifts by some amount. If the 1 year key rate duration is this, what is the expected change in value? And we'll look at that in a little more detail, but a basic formula of what do you do with key rate duration. So we're matching the interest rate issues with duration. We're dealing with non-parallel shifts when we match the key rate duration. By the way, if you match all the key rate durations, you will have matched the modified duration. There are links in these things. But there's also sector exposures. The big, is the index 100% treasuries, and we put a bunch of corporate bonds in there. The spread between the corporate and the treasuries could shift. They're not going to move by the same amount in many cases. So even though the duration are matching, the delta Ys and delta Rs are not the same. So we should also match exposure to sectors. There's another formula, change in spread. Spread is the yield on the higher yield instrument minus the yield on the lower. And normally we're comparing to default-free government securities of the same duration. So if the spread changes, the delta Ys can't be the same. But the durations are the same, so the changes in value can't be the same because the delta Ys differ. That's what delta S is telling you. And it turns out, it's a really handy relationship. If we take minus spread durationship times change in spread, that is the relative performance of the higher yield versus lower yield government security. Spreads are going to widen, you'd have been better off in governments. Spreads are going to narrow. That's the time to go to those higher yield instruments and accept spread risk. Spreads are not going to change. Let's just go get the higher yield instrument instead of the government. Those are things we're going to be exploring in greater detail. These are baseline formulas you're responsible for. There's another way we can end up having done all that. Another approach that will end up producing those consequences is called cell matching. Cell matching is discussed in multiple subjects. It's also used in the equity market. Of course, equities have different kind of characteristics to match. We do this in the equity market as well. So suppose our benchmark, we decide the things we're interested in are the maturity and the coupon rate of the bonds. And we look at the index and analyze, and we determine, for example, that in the 3 to 5 year maturity range, with coupons of 2 to 4%, the index allocates 15% to that cell. So if we put the same allocation in our portfolio in terms of exposure to different coupons and maturities, we're matching the index. So we need to match the exposures in each one of these cells in our portfolio. If we do this, we'll end up doing a pretty good job of key rate and duration matching. If we had changed this to duration characteristic, we've done an even better job. So the manager picks. It's a cell, it's a grid. We're looking at 2 dimensions. You pick the dimensions you think are important, and then we're going to match those exposures. But you've got to pick the relevant factors. If we had looked at one of the factors as being different sectors and matched the weighting by sector, we'd also be dealing with spread risk by doing this. So cell matching is a simple way to look at these kind of issues. Match the characteristics of your index, and you should be matching its performance. How do I control yield curve risk? If I match the portfolio durations, if I match key rates, present value, I'll control yield curve risk. Now, we've got some calculations here. They're not really calculations you're told to be expected to do, but they're things you've seen before. How did you learn to calculate the price of a bond? Well, you can discount the future cash flows. This happens to be a par bond initially with a 6% coupon, so of course its yield to maturity is 6%. And it's an annual pay, so we lay out the cash flows and we lay out when the cash flow will occur. So we get the 6, and the par plus the last 6 coupon. At 6%, we discount it to present value, we add them up, that's called the price of the bond. And because it was a par bond, we knew it was going to come out to 6. But if we hadn't known, we could come up with the price. By the way, if this was a whole portfolio of bonds, and this was the aggregate value of the bonds, and these were the aggregate cash flows, we could by trial and error solve for the internal rate of return of those cash flows that equates their future value, these are the future values of the cash flows, to the present value of the cash flows. That would be called the internal rate of return. That, by the way, is how you do a portfolio level statistic. These wouldn't be the cash flows of one bond. These would be the cash flows of every bond you own, projected out. This would be the aggregate current market value of all of that portfolio. And by trial and error, you would back solve for the internal rate of return. Just as an aside, of course you're not going to do that on the test. You need computer power to make these kind of calculations in reality. But we're seeing how things link together. If you wanted to, and this is an important idea, we could take each of these present value cash flows as a percentage of the total PV and do a weight. So we could calculate the weight of each of those PVs, and those weights are the basis of calculating duration. If we took those weights times when the money is going to occur, year of when the money will come in times its present value weight, and we total it up, that is how Macaulay duration is solved. That is the literal process of calculating a Macaulay duration. We could put some labels on this. These could be called the present value distribution of the cash flows. This weight times when could be called a duration contribution. So since this is the 1-year cash flow, that's the duration contribution of the 1 year. This would be the duration contribution of the 2 year. This would be the duration contribution of the 3 year. And when you add those up, what's that called? That's called Macaulay duration. That's how you calculate Macaulay duration. Now, interestingly, another name for the duration contribution is called its key rate duration. So this is also how you can calculate key rate duration. This is key rate duration 1. This is key rate duration 2. This is key rate duration 3. And when you add up the key rate durations, what do you get? You get the Macaulay duration of the item. So these are redundant terminologies. Now, the point being, if I want to match the duration characteristics of an index, and then if I take my portfolio and I match the present value distribution of cash flows in the portfolio to those in the index, I'll have matched the durations and I'll have matched the key rate durations, and I will be protected from parallel and non-parallel shifts in the default free yield curve. Or if I match the duration contributions, I'll have done the same thing. Or if I match the key rate durations, I'll have done the same thing. So these can be ways to control risk in relation to the index. Match your index, you will perform like your index. That's the underlying driving factor. Sum them up, Macaulay, and of course if you divide by Macaulay, by 1 plus the periodic discount rate, that's also called modified duration. What's our periodic discount rate? 6% per year. Divide by 1.06, and you would have modified duration. What if I do want to go with a passive approach? I just want to match my indexing, pure indexing. Pure, even there, we might need to allow a little practical variation if one of those bonds is not available. If I match the cells, and if I picked the appropriate things to be matching, that could do it. That could be called stratified sampling. So let's say in a certain cell, I need to put 15% of my portfolio assets there, market value. I go select bonds that fit in that cell that will be 15%. I don't necessarily buy every bond in the index, but I do match the weighting. That's called stratified sampling. If I don't want to build my own portfolio, I go and buy an open-ended mutual fund, an index fund, or an exchange-traded fund. Those trade continuously. They trade very close to NAV. Open-ended funds only trade and are priced once a day. You enter and exit at NAV. You got some trade-offs. I could use derivatives. I could enter a swap to pay the short-term rate and receive the total rate of return of a desired bond index. I could buy futures contracts on bonds or options on bonds or options on futures contracts. Those would give me the rate of return of the underlying. By the way, you generally in the bond market can't find futures or options based on broad indexes. So, you have to take what actually existed, or maybe you move into the over-the-counter world where you specify what you want. But you've got multiple ways you can obtain exposure to the bond market on a passive basis. I just want the rate of return of the underlying. All choices. Basic issue is very, very simple. I want to select a benchmark that provides the exposure to the risk and return characteristics that are appropriate. That is the basis of selecting an appropriate benchmark to work with, and then I can use that to evaluate, am I adding or losing value? If I'm an active manager, if I'm a passive manager, I just want to replicate the performance of that benchmark. And this is really ditto for the equity world. Same concepts. Complicating factors in the bond world, I pick that index, but it's an index of bonds, and over time, bonds change characteristics. They get shorter, their duration goes down. We got to think about that. New bonds are issued, bonds come due. The nature of the index might be shifting over time, something to be aware of. One of those cute buzzwords, the bums problem. Indexes are generally market cap weighted. So if you've got a bond issuer who's issuing lots and lots and lots of new bonds, market cap of the bonds is going up. Weight in the index is going up. But often the issuance of lots and lots of new bonds is associated with an increasing leverage and deterioration in quality. So, blindly following market cap weights may not be the smartest thing, because you could run into this issue of somebody who's issuing lots and lots of new bonds. And that means you're upping your weight to somebody who may be deteriorating in quality. Hey, we put a cute name to it, the bums problem. What's the bums problem? So, interesting introduction. As I said, fairly light, but we are going to be turning in subsequent readings to actual management techniques we could be using.